Good evening, everyone. Welcome to the channel. Today I am going to talk about XXF interim report. Do note that this is not a financial advice or a buy or sell call. All content are AI generated and is not associated with anyone. And XXF Group Holdings Limited offers a diverse range of businesses and services, including automobile finance, lease services, sales of non-luxury automobiles, on direct finance, lease car sales, on a one-off basis automobile, operating lease services, other automobile-related services, information technology services, insurance agency services. The skyrocketing success of XXF Group Holdings Limited, a year of unprecedented growth over the past year. XXF Group Holdings Limited, HKEX, 2473, has experienced a remarkable surge in its stock price, increasing by an astonishing 313.73%. Several key events have contributed to this phenomenal growth. The company's initial public offering and listing on the Hong Kong Stock Exchange in November 2023 marked the beginning of its upward trajectory. A share subdivision plan implemented in December 2024 further enhanced liquidity and made shares more accessible to investors, while strong earnings growth reported in mid-May 2024, with a 30% increase in earnings and a 454% rise in earnings per share over 3 years, made the stock increasingly attractive. The company's continued financial success was evident in its interim results for the first half of 2025, which showed a 14.23% year-on-year increase in net profit. Recent strategic collaborations, including a partnership with Hello Car Rental to develop an ecosystem and inclusion in the Hong Kong Stock Connect program, have further broadened the company's market reach and investor base, contributing to its continued upward stock price movement. These developments have cemented XXF Group Holdings Limited as a rising star on the Hong Kong Stock Exchange. The primary drivers of revenue growth or decline can be summarized into several key factors. Revenue growth drivers, global economic growth, and technological advancements in the automotive industry have driven market expansion. Increased production and sales of passenger vehicles in China have contributed to revenue growth. Expansion into new markets, improved service capacity, and successful launches of overseas direct services have also boosted revenue. Domestic business has seen growth through combining demand in China's domestic automobile market and exploring customer demands in lower-tier markets. Revenue decline drivers. Revenue decline was observed in certain regions, such as Southwestern PRC, Central PRC, and Northern PRC. The outright car sales income saw a significant decline due to various factors. Net income and profit margins. A shift in focus. The financial summary reveals a significant change in the company's net income and profit margins over time. While net income is not directly mentioned, the impact on profit margins is evident. The gross profit margin decreased from 31.8% to 30%, indicating a slight decline. This shift can be attributed to the rapid growth of the outright car sales business, which has lower margins compared to other areas. Despite an increase in gross profit by 10.3%, the decrease in profit margins suggests that the company is prioritizing volume over profitability. This strategic decision may have contributed to the change in net income and profit margins, highlighting a shift in focus towards growth at the expense of margin expansion. The company's financial performance indicates a strong ability to generate cash from its core operations. With both page 12 and page 23 confirming the same, it is clear that the company is producing positive operating cash flow. This suggests a healthy financial position, allowing for investments in growth initiatives or debt repayment. The company's debt level has seen significant changes over the past year. Notably, net debt increased by RMB 169,656 from RMB 1,952,155 to RMB 2,121,811. While total debt rose by 6.9% from RMB 2,281,558 to RMB 2,441,445. However, interest expenses have decreased, with a drop of RMB 6341 from RMB 81,410 in 2024 to RMB 75,069 in 2025. This decrease in interest expenses is a positive trend for the company, despite the increase in debt levels. Management's outlook. Focusing on domestic growth and international expansion, the company's management is optimistic about its future prospects, with a dual-pronged strategy to drive growth. Firstly, they are focusing on expanding their domestic business in lower-tier markets, where there is significant potential for growth. This approach aims to tap into untapped customer bases and increase market share. In addition to this, the company plans to expand its overseas business through strategic partnerships, new subsidiaries, and targeted brand promotion. By establishing a stronger presence globally, management seeks to capitalize on emerging opportunities and further diversify the company's revenue streams. There were no significant acquisitions or divestitures in the company's financial activities. This indicates a stable and conservative approach to business expansion and restructuring. Concerns about inventory buildup and supply chain disruption. The financial summary reveals concerns about inventory buildup, indicating potential issues with supply chain management. Despite a decrease in net inventories from RM 72.1 million to RM 53.1 million, the secured inventory decreased by 23% from RM 3 million to RM 79.6 million. The cost of inventory increased significantly from RM 341,213 to RM 410,108, while the provision for inventories also rose from RM 3539 to RM 8628. Furthermore, more items were transferred to inventory in 2025 compared to 2024, suggesting a potential buildup of unsold goods. These indicators suggest that there may be concerns about inventory buildup and supply chain disruption. That concludes the financial summary for XXF. Feel free to comment below, and I will be happy to answer them when possible.